Is the private equity firm Blackstone misleading or even potentially defrauding their investors?
The Blackstone Real Estate Income Trust is up around 9% year to date as of last month. Look at that, it's the only one that's up.
People don't fully understand the significance of BREIT, Blackstone's Real Estate Income Trust. It's a large fund. It has $114 billion. If we compare it to the next biggest one, the Vanguard Real Estate Fund, VNQ, it has $32 billion. If we just look at VNQ versus BREIT, VNQ charges 0.12%. BREIT is 1.25 plus a performance fee of 12.5 plus front loads or commission fees of over 3%. And one is about public market, the other one is private. And typically private funds are known to be smaller. BREIT is generating at least 20 times more fees. But even more important is that BREIT is the vanguard, not to make a play of word, of something even bigger, the democratization of alternatives, the access of private assets from individual investors. I don't know if it's 60,000 people investing $1 million or perhaps a lot more people investing small checks. And what's crazy is that despite all those superlatives, BREIT is still a mystery. I revisit it now because there's been a lot of news. Business Insider called it a house of cards. Last year it failed to cover its dividend. Performance has stalled, but it's having its biggest quarter yet in terms of assets raised. And that just doesn't make sense. So the issues in the news are not new. In fact, I discussed them a year ago with Phil Bak, the CEO of Armada ETFs, and a reference in the world of real estate investing. I'm going to reuse this conversation because it's still very much relevant today. The same questions, the same challenges that Phil identified, but I want to revisit it with all the insights we've gathered since.
Blackstone has done a very good job. We know these properties, we know the different... We think they've done a very good job at selecting properties and managing properties. The performance of this fund has been great. And where we stand today is kind of interesting. They had been raising capital and they had inflows coming into the fund. And if you have redemptions, so people trying to get out of the fund and people trying to get in, great, you can offset the two, right? No big deal. What happened here was all at once, you had the redemption requests, you had inflows or new people coming into the fund drying up because people are now concerned about the market and concerned about real estate. And they didn't have enough inflows to offset the redemptions. They own a lot of commercial CMBS and different liquid vehicles that they can use to provide liquidity, but they didn't have enough. And what you do in that situation, if you're them, it's no big deal. So this isn't like an FTX situation, like they own the properties, they just sell the properties. And then they can use the cash to give people their money back. But they found what everyone in the commercial real estate market knows, which is that liquidity is almost non-existent now, with financing costs all of a sudden so high. So they've been unable to meet liquidity demands for a while now. And, you know, they gated the fund, which means that you can't get your money out. You can get out now 5% a quarter maximum. Every time you put in a redemption request, they fill a little bit. You got to resubmit every month, resubmit to try to get your money out. They incentivized University of California to invest $4 billion, $4.5 billion, I think, in this fund. They gave them a preferential waterfall return stream. I mean, it's outrageous, and that might work for a little bit, but what happens next quarter? So
yeah, I just want to pause on this one because it's something that seemed quite extraordinary. They pulled this deal out of the hat because I guess they're Blackstone, so they can, you know, call all the pension funds and say, hey, look, we've got a deal for you. But this is quite something. This has not been fully covered by the media, whereas the out of redemption started really bubbling up, right? And certainly there's been this deal, but I don't know. It seems extraordinary to me. Do I get it wrong? Is this something that people do, give preferential treatment to one investor?
It is extraordinary. It is extraordinary. And if you're in a fund, it is extraordinary. And if you're a retail investor in this fund, your money's locked up and you don't have the preferential treatment. I wouldn't be very happy with Blackstone. You're telling me that I can't get my money out, and you're incentivizing new people to come in with a better deal than I get? Like that doesn't seem, you know, you talk about this fund is democratizing, you know, access to real estate. That doesn't sound very democratic to me at all. But that's not even the biggest issue here. Mm-hmm. The biggest issue, I mean, you got high fees in this fund. Now you have no liquidity. You used to have low liquidity. Now you've got, you know, real liquidity concerns. But the biggest issue here is that The way that, so I talked about how publicly REITs are traded on the exchange, and you have price discovery happens every day. What's someone willing to buy it at? What's someone willing to sell it at? They're fairly liquid. They're very clear what these things are worth. The way a fund like BREIT works with the non-traded REITs is they use appraisers to come in and tell them what each value is worth. And the appraisers come in, and revalue the properties maybe once a year, depending on the fund, sometimes a little more frequent, but, not terribly frequent. And appraisers are humans. They themselves have a bias, and this has been proven. They have a bias away from volatility. So whatever I marked it at last year, that's kind of my baseline. I'm not going to give it a wildly different valuation this year, typically, right? I'll be more anchored to my historical valuation than I would in the public markets that just don't care. They're saying, hey, S&P's down, rates are up. We're just going to make our markets wherever our models tell us to. So the publicly traded REITs have gone down 20% over the last year, and these private REITs are up. They're up, according to the appraisers, according to what Blackstone is putting out. Now, the incentives here, right? Now, this isn't Blackstone just saying, hey, we're going to mark this thing wherever we want. They have an appraisal process, and I think their appraisers are very good, and they're sophisticated in their approach. However, it is important to note conflicts of interest and incentive structures. I mean, you have to, I'm not saying that these are driving the valuations entirely, but they could have some impact on it. And Blackstone is collecting a fee, 125 basis points on the NAV. The higher the NAV, the higher the fee. But if you put the fee too high, say, okay, great, you're mispriced it too high. I sell, right? No big deal. I can sell and capture that gain, but you can't sell. You cannot sell. You're gated. You're stuck in. So you can't arbitrage away the higher NAV. You can't short it. There's no liquid way to do that. You can't even sell and get your money out. So a lot of people are collecting dividends, which are getting reinvested at the inflated NAV. So your dividends are kind of fake. They're inflated. Your NAV is fake, but you're paying a fee on a higher number. And we think that there's a 20% delta right now between where these things are being marked on their NAV and where they should be based on public market comps. Now, you can say that, well, Blackstone is so smart. They're really good at managing properties. They are. I think they are too. I came to the same assessment. I think they're very good at what they do. But are they 20% better after clearing a 300 basis point annual compounding fee difference between the private REITs and the public REITs? That's simply inhuman. That's simply not possible. There's nobody that can do that. Buffett couldn't do that. There is nobody that could do that. So
and it's quite fun to look at the NAV. I've been just zooming in on the NAV right now, and it's like it managed to be it's just stable. Well, which is kind of almost comical.
I mean, this is beautiful. I would love to invest in this too if it were true, right? A real unfortunate thing here, and one of the things that I've written about is, the more portfolio management is on the allocation on the portfolio level is being automated, the more securities are being selected based on a client's risk profile and based on the standard deviation or the volatility of the underlying risk assets. Because this chart looks like this, right? Because we see almost no volatility historically in BREIT and these private REITs, this fund has been optimized in for investors that are least risk tolerant. And what that means is that widows and orphans and people that think they're in very safe investments, they think they're in treasuries, or the people that cannot afford the 15 to 20% drawdown that we see coming in this fund are the very same investors that are in this fund with no way out.
And probably topping up on a regular basis. Now, okay, that's a very clear and very important update, Phil. Thank you very much. There's a couple more things that I want to zoom in what you said. One is liquidity. And you mentioned obviously no liquidity, it's gated. There's I think 5% every month or something like that. But there's perhaps a misconception that, if it's a big fund, it's going to be liquid. And also that liquidity goes both ways, right? But you can buy as much as you want, perhaps, but it doesn't mean you can sell as much as you want. And this is true for not just BREIT, but this is kind of a general private assets thing, right? But can you tell us a little bit about this? It's something you mentioned as well in your Substack about this size of the fund and liquidity, because I think that's something that I see very often, ETF investors in general, perhaps getting confused.
Yeah, well, that's that. I mean, you hit the nail on the head. This perception that the bigger is more liquid. The bigger the fund is, the more liquid it is. And a small fund is illiquid. And that might be true of stocks, of companies, of securities, but it's not true of funds because funds trade off the underlying. So like our fund is brand new. It's not, we're not big, aggressive distribution people. We're not paying fancy, wholesalers to go out and take everyone to lunch. And our fund is small. I've got about $4 million today that we're recording this in the fund. It's small, but it's liquid. If you talk to a market maker, say, how much of this fund can I buy? And they calculate, well, how much of the underlying REITs can they source? They'll tell you that they can make a market of literally $2 billion on a $4 million ETF today without moving the price, right? So that's liquidity. And we have people for the underlying REITs that we buy. You have market makers that are sitting there on the bid. You have investors that are sitting there on the bid. They're sitting there on the offer every day. When the New York Stock Exchange is open from 9:30 a.m. to 4 p.m. Eastern, every market day, you have liquidity in the underlying REITs, which means liquidity in the ETF. Now, this idea that big funds, because there's so much assets in it, those are liquid, is preposterous. Because if you look at every big implosion that we've had, right, it always follows the same script. It always follows that there's a period of low volatility or some false sense of security. Everyone piles in, and then everyone's in, and there aren't enough lifeboats, and nobody can get out. And that's exactly what's happening now in the private REIT funds. These funds are huge, but they're not liquid. They're not liquid at all. They're gated. You said 5% a month. It's 5% a quarter is all you can get out.
So everything that Phil mentioned is still relevant. The update is that they seem to have solved these outflow problems. And also, well, they reversed it because people are adding money. And that's despite the mounting pressure from the media and the questions that pile up on valuation. In Blackstone's Big Gamble article from Beth McLean, which is a name that I'll come back to because it's significant, one of the analysts says that the fund could be 55% overvalued. And if you look at a chart, these are conclusions that seems fairly intuitive. What's clear is that the people who invest don't follow the news. They're not influenced by this article from Business Insider or the New York Times. Something else is touching them, and that's what we're going to get to. There's a lot of things that don't make sense financially, but they don't influence the inflows. So, for example, from a financial perspective, it doesn't make sense to pay out dividends that are not matched by the actual income of the fund. Or this University of California deal, which cost a lot of money to the fund, it also seems crazy. You've called it having a fantastic deal here to the detriment of the other holders. You could say to those investors, listen, you've invested in a real estate fund, the overall market is down, and hopefully, we've outperformed, so you should be quite happy, but this is not what's happening. In any case, it seems like the investors are very much isolated from this financial argumentation. And that's why, to understand the fund, to understand what's happening, you need to look at it from a marketing point of view. And that's what we're going to do next. And it's important to know how this fund was born, because private REITs are not new, but they were heavily criticized. In fact, the SEC sent investor warnings. That was in 2016, and that means that most of the serious players didn't want to be involved in that. But in 2017, Blackstone saw the opportunity. They also have private real estate funds that they market to large institutional investors, but they saw the opportunity to market it to private investors. And that in itself is a show of skills, because those products are not bought, but sold. That's an expression that's often used in the industry. It means that it's not like you're buying it off the shelf, you're selecting something from your broker. No, it's something that someone will pitch to you, and then you'll decide to make a purchase. And that's where it's important to know the fee structure, because these funds have, on top of the management fees and the carry, they have upfront commission, sales commission of 3%. If you look at the asset management industry, people typically choose to go for low-fee ETFs, and the active management fund, which have typically fees over 1% and over, are running out of favor. You can't understand the success of BREIT without that, right? But it's also a great product for that market. If you think of when it was launched in 2017, it was at the time when interest rate was zero and people who were looking at income were desperate. And they offered a very significant interest rate of 4.5%, which they've delivered all the time. And that's also explaining why, even if it doesn't make financial sense to pay the dividend, you want to keep that income coming for the people, because that's what they're looking at. You can think of my dad, who is very much income driven and barely looks at the valuation, but always looks at the income that his assets generate. This is very much about the user experience. That user experience also explains the University of California deal. which is really so expensive financially. But if it allows to keep smoothing the NAV, if you look at it from a marketing point of view, if you think of dividends and stable valuation as product feature, if you think of the BREIT investors as an audience that look at the updates as content and they don't want stress from that. If you consider this whole BREIT as user experience, then that's something that Blackstone delivered and keeps delivering. And that's the way to understand the fund. But of course, that raises the question of the end game if the published NAV is at odds with the actual value of the assets. Another guest from this podcast published an article with a possible outcome. I'm going to use an AI voice to read it.
Naturally, there are private equity and real estate funds that can outperform their markets. But how likely is that for a $113 billion fund? It will be interesting to see the performance of BREIT over the next few quarters, as something has to give. Perhaps real estate valuations will increase and Blackstone will get lucky by being able to avoid a drawdown in BREIT. However, more likely is that BREIT's external appraisers, which theoretically are independent but practically are conflicted as they get paid by Blackstone, will slowly decrease valuations to get these closer to the market. If that leads to an increase in redemptions, then this will likely result in steady losses in BREIT as Blackstone is forced to sell and write down the portfolio asset by asset.
From a financial point of view, there could be a reckoning and something dramatic happening soon. But my opinion is that it will not happen because remember what is at stake with BREIT. It's bigger than the fund itself. It's the democratization of alternatives, an opportunity for private wealth, which Blackstone estimates at $80 trillion, and the main driver of the growth of the firm, the main driver of the growth of the whole industry. They will not let it happen, not without a fight. And Blackstone can put up a huge fight. We've seen it with University of California. We've seen nothing yet. Just some ideas. They have $200 billion in dry powder. Obviously, this is not pocket money that they can allocate however they want, but they could find a way to use it in an emergency. There are many other endowments like University of California who could be offered a guaranteed rate. But they can also find a much better idea than I cannot come up with here because they are the smartest marketers in the room. And remember Enron, the smartest guy in the room? Obviously, that's where I got it from. And it's a book written by Beth McLean. Beth McLean, who wrote the Business Insider article about Blackstone. And I think that's a great reference. But as she concludes, she missed another reference.
In the absence of a market price, independent accounting and tighter government regulation are needed to ensure that investors have the accurate, verifiable numbers they need to make informed decisions. With private funds like BREIT, too much maneuvering takes place in the dark. And if history is any lesson, the dark is a very bad place to be doing business.
When she's talking about a house of cards, she meant, of course, the fund could collapse. But there's a cultural reference that matches the maneuvering in the dark and the name. It's House of Cards, the Netflix series, Kevin Spacey as president. Underwood, he's maneuvering in the dark so well that he ultimately becomes an elected president of the United States. So I leave you with that cultural reference to think upon Blackstone and the democratization of alternatives. And if you've gone so far, remember, we've got a lot of other podcasts that talk about private equity, market of alternative assets, and so on, including the one that I recommend particularly is this conversation with Professor Philippou, an Oxford professor who teaches private equity, but is also critical about it. Thank you very much for listening.